The thing most people miss about banking systems is that the risk does not usually announce itself. It does not begin with a headline that says your money is no longer as liquid as you think it is. It begins quietly. It begins with new rules, new compliance standards, new reporting obligations, new technologies, and new incentives inside the banking system. Each one looks small when you look at it alone. Each one can be explained as reasonable. Each one can be defended as a response to fraud, money laundering, bank failures, tax collection, or financial stability. But when you put them together, you see the system changing. And when a system changes, the person who does not understand the mechanics becomes the person who pays the price. I have spent my life studying how systems work, economies, markets, debt cycles, political systems, empires, and human behavior. One of the most important principles I have learned is this: what you think you own and what you can actually access under stress are not always the same thing. That is especially true inside a banking system. Most people look at a bank account and see safety. They see a number on a screen. They see deposits, savings, retirement cash, business cash, family money, emergency reserves, and they assume that because the account is in their name, the money is fully under their control. In normal times, that assumption feels true. In stress times, it can become dangerously incomplete. What is happening now is not a conspiracy. It is not a call to panic. It is not a prediction that every bank is about to fail or that every government is about to seize money. It is something more practical and therefore more important. The rules governing how money can be held, moved, monitored, frozen, reported, and restricted are being tightened across the developed world. And the people with the most to lose are not always the people doing anything wrong. Often, they are simply the people who have accumulated savings, crossed a reporting threshold, failed to update an old account, made an international transfer, held too much in one institution, or assumed that the old banking model still worked the way it did after the last crisis. That old model is changing, and if you are retired, if you are holding significant cash, if you own assets across borders, if you send money internationally, if you use crypto, if you own gold, if you hold more than the insured deposit limit, or if you simply want to make sure your savings remain accessible when you need them, you must understand the new reality. Let me take you through it step by step because this is how I think about risk. I do not begin with fear. I begin with mechanics. The first major shift is the move from bailouts to bail-ins. For most of the last century, people believed that if a large bank got into trouble, the government would step in and save it. That belief became very strong after repeated crises, and especially after 2008, when governments spent enormous sums to stabilize banks and prevent the system from collapsing. But that created a political and economic problem. Taxpayers did not want to keep paying for banks that had taken too much risk. Regulators did not want the next crisis to require the same public rescue. So after the financial crisis, the system began moving toward a different model. Instead of a bailout from the outside, regulators developed tools for a bail-in from the inside. That sounds technical, but the principle is simple. If a bank becomes insolvent or faces severe losses, the losses are absorbed by parts of the bank's own capital structure, first by shareholders, then by bondholders and other creditors, and in extreme cases by large uninsured depositors. That last phrase is the one most ordinary people do not understand. A deposit above the insured limit is not the same thing as money in a safe that belongs only to you. Legally and economically, it can function as an unsecured claim against the bank. In the United States, the standard insurance limit is $250,000 per depositor, per insured bank, per ownership category. In other jurisdictions, the limits are different. The numbers vary, but the principle is the same. Everything above those limits can carry a different type of risk. Most of the time, that risk is invisible. It does not matter if the bank is stable, liquid, and well capitalized. But during a banking crisis, invisible risks become visible very quickly. This is why sophisticated people do not simply ask, "How much cash do I have?" They ask, "Where is that cash held? Under what legal regime? What is insured? What is uninsured? What happens if the bank is resolved? What happens if withdrawals are restricted? What happens if regulators act over a weekend?" That is how you must think. The mistake is not holding cash. Cash can be very useful. The mistake is assuming that all cash held in all banks under all conditions is the same. It is not. A system under stress always reveals the difference between apparent liquidity and real liquidity. The second shift is less dramatic, but it catches people because it feels so ordinary. Dormant accounts. Most people do not think of an inactive account as dangerous. They think, I opened that account years ago. There is still money in it. It is mine. But in many countries, if an account sits inactive long enough, it can be classified as dormant or unclaimed. Once that happens, the funds may be transferred to the state under unclaimed property or escheatment laws. In many cases, you can reclaim the money later. But reclaiming is not the same as uninterrupted control. It can be slow, bureaucratic, frustrating, and sometimes difficult for heirs who do not know where the accounts exist. The real issue is not that these laws exist. Some version of them has existed for a long time. The real issue is that the time periods and asset categories are changing. In some places, dormancy periods have shortened. In others, dormant asset schemes have expanded beyond ordinary bank accounts into investments, insurance balances, and other financial assets. In still others, policymakers are discussing ways to harmonize rules across regions, which often means moving toward a lower common threshold. To most people, that sounds administrative. To someone who studies systems, it means something else. It means the state is increasing the number of situations in which private financial assets can be reclassified, transferred, and placed under government custody because the owner failed to maintain activity or contact. That matters especially for older people, families with inherited accounts, people with accounts in multiple jurisdictions, and people who set money aside and simply forget about it. You do not need to be irresponsible for this to happen. You only need to be passive. And passivity is one of the most common financial mistakes people make in complex systems. If you have accounts, they must be part of a living map. You should know where they are, who has access to them, what the activity requirements are, what happens if you die, what your heirs know, and what records exist. The third shift is civil asset forfeiture and asset freezing without a criminal conviction. Most people believe that the government can take assets only after proving a crime. In some areas, that is not how the system works. In many developed countries, there are legal mechanisms that allow authorities to freeze or seize assets based on suspicion, probable cause, unexplained wealth standards, proceeds of crime rules, or compliance concerns long before a final court judgment is reached. These tools were created for serious reasons. They were meant to fight organized crime, corruption, money laundering, tax evasion, and illicit finance. The problem is that tools built for extreme cases can sometimes touch ordinary people when the facts are unclear. The patterns look suspicious or the legal process becomes aggressive. This is one of the big lessons of history. Rules designed for bad actors can become risks for good actors when the system is under pressure and the burden of explanation shifts. A frozen account is not the same as a lost account, but if you cannot access money during a legal or compliance process, the practical effect can be severe. Bills still come due. Businesses still need operating cash. Families still need liquidity. Retirees still need to live in those moments. Being right in the long run may not help you if your money is inaccessible in the short run. That is why resilience matters. The purpose is not to hide money. It is not to evade law. It is not to avoid taxes or reporting obligations. Those are bad decisions that create bigger risks. The purpose is to understand that if all of your liquid assets sit inside one legal system, one bank, one currency, and one compliance framework, then you have concentration risk. Most people understand concentration risk when it comes to stocks. They understand that owning one stock is riskier than owning a diversified portfolio, but they do not apply the same thinking to banking. That is a mistake. Banking concentration is still concentration. The fourth shift is capital controls. This is the one people usually believe cannot happen where they live. They believe capital controls belong to emerging markets, unstable countries, places with weak institutions, or governments that have already lost credibility. That belief is historically false. Capital controls have appeared in developed economies during financial stress. They can include limits on withdrawals, restrictions on international transfers, caps on foreign currency conversion, delays on moving money out of the country, and rules that trap deposits inside the domestic banking system. The key thing to understand is that capital controls are not usually introduced when everything is calm. They appear when policymakers feel they have few choices left. That means by the time the average person realizes controls are possible, it is often too late to move money freely. This is a general principle. The cost of building optionality before a crisis is usually small. The cost of trying to build optionality after a crisis begins is often very high or impossible. If you have all of your liquid assets inside one domestic banking system and that system experiences stress, you are dependent on the rules of that system at the worst possible time. If you already have a properly reported, legally compliant account in another strong jurisdiction before stress occurs, you have a different set of options. You are not guaranteed safety. Nothing in finance is guaranteed, but you are less dependent on one gate. That is what sophisticated risk management is. It is not predicting exactly what will happen. It is not saying capital controls will happen tomorrow. It is saying, if this happens, what options will I have, and what can I do now legally and prudently, so that I am not forced to improvise later. The fifth shift is restrictions on what assets people can hold and how they can hold them. Governments increasingly shape the financial choices available to citizens through tax rules, reporting rules, anti-money laundering rules, suitability standards, crypto regulations, foreign account rules, gold transaction reporting, stablecoin restrictions, and restrictions on certain types of investments. Each rule may have a rationale. Some are meant to reduce risk, some are meant to prevent fraud, some are meant to protect investors. Some are meant to improve tax compliance. Some are meant to preserve financial stability. But when you look at them together, they reduce freedom of allocation that matters. Because in a world of debt cycles, inflation, currency, debasement, and geopolitical fragmentation, the ability to choose where and how you hold wealth becomes more important, not less important. If governments are deeply indebted, they have incentives. They want tax revenue, they want money inside the domestic system, they want visibility, they want stability, they want control over flows. Those incentives do not mean they will do anything extreme tomorrow. But incentives matter over time. When incentives build in one direction, policy tends to move in that direction. So when I see more restrictions on foreign funds, more scrutiny of crypto, more reporting around gold, more compliance around cross-border transfers, and more limits on certain financial instruments, I do not treat them as isolated events. I treat them as signals. The signal is that the system is becoming more controlled, more monitored, and less frictionless for the individual. You do not respond by doing something reckless. You respond by knowing the rules, staying compliant, documenting what you do, and avoiding unnecessary dependence on a single policy environment. The sixth shift is currency debasement and the possibility of central bank digital currencies. This one is different because it is not only about the banking rules, it is about money itself. When central banks expand the money supply faster than the real economy grows, purchasing power declines. That is not an opinion. It is a mechanical relationship over time. People experience it as inflation. They see that their bank deposits still show the same number, but the number buys less. They see that the interest paid on cash does not keep up with the cost of living. They feel safe because the nominal value stayed the same, while the real value quietly eroded. That is one of the most important things to understand about money. You can lose money without seeing the account balance fall. You lose it when purchasing power falls. For people who have worked their whole lives, saved carefully, and kept too much money in deposits, earning too little interest, this can be devastating. It is a slow confiscation through the loss of real value. At the same time, central banks around the world have explored or tested central bank digital currencies. The future use of these systems remains debated. Some versions may be benign payment infrastructure. Others raise real questions about programmable money, negative interest rates, transaction limits, targeted stimulus, spending restrictions, or greater government visibility into financial behavior. I do not know exactly how these technologies will be used in every country, but I do know how to think about them. A tool that gives central authorities more direct control over money can be used well or badly depending on the governance around it. The existence of the tool changes the range of possible policy actions that is enough to matter. When the range of possible controls increases, prudent people think harder about diversification, liquidity, hard assets, legal structure, and jurisdictional risk, not because they assume the worst, because they refuse to be unprepared for it. The seventh shift is tax authority reach and cross, border freezing risk. Every developed country has mechanisms that allow tax authorities to freeze bank accounts under certain conditions, usually connected to unpaid taxes, assessments, investigations, or court orders. International agreements allow authorities to exchange information across borders. Systems like FATCA and other information sharing treaties have made the financial world far more transparent than it used to be. People often misunderstand this point. The issue is not whether taxes should be paid. Taxes should be paid. Reporting obligations should be followed. If you hold foreign accounts, you must understand and comply with the rules that apply to you. The issue is that even compliant people can be exposed to freezing risk, investigation risk, documentation risk, and cross-border enforcement processes if something is misunderstood, disputed, or aggressively pursued. That is why the quality of the jurisdiction matters. Some countries require full domestic court proceedings before enforcing foreign tax claims. Some require specific treaty provisions. Some require strong documentation before acting. Others may act more quickly once a legal request is received. These differences matter. People often think a foreign account is either safe or unsafe. That is too simple. The right question is, what legal process must occur before my funds can be restricted? What treaties apply? What court oversight exists? What due process exists? What documentation do I need? What professionals should I have? This is how careful people think. They do not try to beat the system. They build a structure that can survive contact with the system. The eighth shift is transaction monitoring. This is probably the most common way ordinary people experience the new banking world. Every bank now monitors transactions under anti-money laundering and counter-terrorism financing rules. In the United States, suspicious activity reports can be triggered. In Canada, Australia, the United Kingdom, the European Union, and many other places, similar systems exist. The mistake many people make is believing that if they stay below a formal threshold, they will avoid monitoring. That is false. Monitoring is no longer only threshold-based. It is increasingly behavior-based. Banks look at patterns, counterparties, geography, transaction types, cash withdrawals, crypto-related activity, unusual account behavior, and changes from your normal profile. The system asks, does this behavior fit what we expect from this customer? If it does not, you may face questions, delays, frozen transactions, account reviews, or even account closure. The frustrating part is that the bank may not believe you did anything wrong. It may simply decide that the risk of keeping the account is higher than the profit from serving you. This is another example of incentive structure. A bank that misses suspicious activity can face penalties. A bank that inconveniences an innocent customer usually faces much less risk. So the incentive is to over-monitor, over-report, and sometimes over-freeze. That means the individual must adapt. If you routinely send large transfers, move money abroad, withdraw cash, receive unusual payments, interact with crypto, run an international business, or help family members across borders, you need a banking relationship that understands your profile before a transaction hits the system. You cannot assume the bank will understand later. You must help them understand before. Good banking is not just an account. It is a relationship between your actual financial life and the institution's risk model. If the two do not match, you will eventually have problems. The ninth shift, though sometimes hidden inside the others, is information sharing between banks, compliance systems, and financial institutions. This is not always visible to the customer, but it changes the environment in the past. One institution might know only what happened inside its own account. Today, through regulatory systems, shared compliance databases, payment networks know your customer standards, and financial intelligence frameworks, more information can move through the system faster. That means one account issue can sometimes affect another account. One flagged activity can influence how another institution views you. One compliance concern can make future banking harder. Again, this does not mean you did anything wrong. It means the financial system increasingly treats identity, behavior, and risk profile as portable data. That creates both efficiency and vulnerability. It is efficient because criminals are harder to hide. It is vulnerable because innocent complexity can look like risk. This is why documentation is so important. If your money has a clean source, document it. If your transaction has a legitimate purpose, document it. If you are moving money between accounts, keep records. If you have business income, investment proceeds, gifts, inheritance, or property sale funds, preserve the paper trail. In a monitored system, the person with documentation has power. The person without documentation has a story. And in a compliance review, a story is weaker than a record. The 10th shift is de-risking. This is one of the most underappreciated changes in modern banking. Banks sometimes close accounts not because the customer committed a crime, but because the customer's profile is considered too complicated, too costly, too exposed, or too risky. This can happen to people with international transfers, crypto activity, politically exposed connections, businesses in certain industries, relationships with certain countries, large unexplained flows, or patterns that do not fit the bank's preferred customer model. The bank's logic is simple. If the customer creates compliance, cost, and risk, and the account is not profitable enough to justify that cost, close the account. To the customer, that can feel shocking and unfair, but the bank is not a charity. It is a regulated, risk-taking institution. When the regulatory cost of serving a customer becomes too high, the bank may remove the customer. That is de-risking. The lesson is not to fight reality. The lesson is to bank with institutions aligned with your profile. If you are an international person, use banks that understand international people. If you send large transfers, use banks accustomed to large transfers. If you hold assets in different jurisdictions, use institutions that understand cross-border wealth. If you operate in areas that create compliance questions, make sure the bank knows your activity and is comfortable with it before you rely on the account. A banking relationship that works for a simple domestic salary account may not work for a complex financial life. That is not good or bad, it is a match problem, and match problems must be solved before stress appears. The 11th shift is the restriction of physical cash. This is already visible in many developed countries. Some countries place formal limits on cash payments. Some restrict large cash transactions. Some banks make cash withdrawals harder. Some merchants no longer accept cash at all. Some payment processors, insurers, and banking policies make cash less practical even when it remains legal. This trend is often justified by efficiency, anti-money laundering enforcement, tax compliance, safety, and convenience. But it also changes the balance of power between the individual and the financial system. Cash is imperfect. It can be stolen, it pays no interest, it is inconvenient in large amounts, it creates reporting issues, but cash also has a feature that digital balances do not have. It can function outside the banking network. As societies move away from cash, more economic life becomes dependent on financial intermediaries, payment processors, banks, governments, and digital systems that increases convenience in good times and dependence in bad times. The point is not that everyone should hoard cash. The point is that when a society removes one layer of financial optionality, people become more dependent on the remaining layers. And when those remaining layers are heavily monitored, programmable, restricted, or subject to outages and compliance freezes, the individual has less room to maneuver. So what should a thoughtful person do with all of this? The wrong response is panic. The wrong response is hiding money. The wrong response is refusing to use banks. The wrong response is breaking laws or avoiding taxes. Those responses create more fragility, not less. The right response is to build a resilient financial structure. Resilience means you can absorb shocks without being forced into bad decisions. That starts with understanding your deposit exposure. If you hold more than the insured limit in one institution, know exactly why. Know what is insured, what is uninsured, and whether the excess should be spread across accounts, ownership categories, banks, or safer instruments. Do not let laziness create concentration risk. Then map your accounts. List every bank, every brokerage, every retirement account, every foreign account, every old account, every dormant account risk, every insurance balance, and every investment account. Make sure you know the activity requirements. Make sure your contact information is current. Make sure your heirs or trusted representatives know where to find the map. Most people do not lose control because the system attacked them. They lose control because their own records were disorganized. Then build documentation habits. Large transfers need explanations. International transfers need paper trails. Asset sales need closing statements. Gifts need records. Business flows need invoices. Crypto activity needs tax records. Gold purchases need receipts. Inheritances need estate documents. Account transfers need statements. Do not wait until someone asks. Build the record when the transaction happens. Then consider jurisdictional diversification legally and carefully. That does not mean moving everything overseas. It does not mean chasing secrecy. In the modern world, secrecy is usually an illusion and often a liability. It means understanding whether some portion of your liquid assets should be held in a strong, stable, well-regulated jurisdiction outside your home country with proper reporting and professional advice. The purpose is not evasion. The purpose is optionality. If your home country faces capital controls, banking stress, currency pressure, or aggressive enforcement, having some assets already positioned under a different legal framework can matter. But it must be done properly. It must be reported properly, and it must fit your actual life. Then match your bank to your profile. If you are simple, a simple bank may work. If your life is complex, your banking must be more sophisticated. A person who sends large wires, holds foreign assets, owns businesses, uses multiple currencies, or moves between countries cannot rely on the same assumptions as someone with one paycheck and one domestic checking account. Different financial lives require different banking relationships. Then keep enough liquidity in more than one place. One of the great mistakes in finance is believing liquidity exists because a spreadsheet says it exists. Liquidity means you can access value when you need it. If one bank freezes a transfer, if one account is reviewed, if one card stops working, if one country restricts movement, do you have another path? That is the question, not because you expect failure every day, because you do not want your life to depend on everything working perfectly. Then think about real purchasing power. Money in the bank can lose value quietly. If inflation exceeds the return on your deposits, your real wealth is shrinking. That does not mean you should take reckless risk. It means cash should have a purpose. Emergency cash, transaction cash, opportunity cash, and safety cash are useful. Dead cash held forever, without a plan, can become a slow loss. You must distinguish between safety in nominal terms and safety in real terms. They are not the same, then stay compliant. This may be the most important principle in a monitored world. Clean behavior is not enough. Clean records matter, legal structure matters, tax reporting matters, consistency matters, professional guidance matters. When people become afraid of the system, some of them are tempted to hide. That is dangerous. The better approach is to be transparent where required, organized everywhere, and diversified enough that one institution, one country, or one rule change cannot completely trap you. That is how resilient people think. They do not fight the river with emotion. They understand the current and position themselves wisely. What worries wealthy people is not one banking rule. It is the direction of travel. Bail-ins show that uninsured depositors can be part of the loss, absorbing structure. Dormant account rules show that inactive assets can be transferred if you fail to maintain control. Civil forfeiture shows that assets can be frozen before a final conviction. Capital controls show that access to money can be restricted in a crisis. Asset restrictions show that governments can shape what you are allowed to hold. Currency debasement shows that bank balances can lose real value even if they do not fall. Digital currencies show that future money may be more controllable than past money. Tax enforcement systems show that cross-border assets are increasingly visible. Transaction monitoring shows that even legal behavior can trigger review. De-risking shows that banks can remove customers who do not fit their risk model. Cash restrictions show that the physical escape valve is narrowing. You do not need to be frightened by this, but you do need to be awake. Systems do not usually break in one moment. They tighten, they adjust, they centralize, they monitor, they add rules, they add permissions, they add exceptions. Then one day, a person who never paid attention discovers that the freedom they assumed they had was conditional. My approach is simple. Study the machine before the machine is under stress. Know where your money is. Know who controls access. Know what law governs it. Know what happens if the bank fails. Know what happens if the account is inactive. Know what happens if you need to send a large transfer. Know what happens if your tax authority asks questions. Know what happens if the currency loses value. Know what happens if the country imposes restrictions. Know what happens if your bank decides you no longer fit their risk appetite. Most people do not ask these questions when times are good. That is why they are surprised when times are bad. The people who survive cycles are not the people who believe nothing can go wrong. They are the people who assume that systems have stress points, identify those stress points in advance, and build enough redundancy that one failure does not destroy them. That is true in investing, it is true in economics, it is true in politics, and it is true in banking. Your bank account should not be treated like a black box. It is not simply a place where money rests. It is a legal relationship with an institution inside a regulatory system, inside a currency system, inside a political system, inside a debt cycle. When you see it that way, you make better decisions. You stop asking, is my money safe? You start asking, safe from what? Safe from bank. Failure is one question. Safe from inflation is another. Safe from account closure is another. Safe from government restriction is another. Safe from legal confusion is another. Safe from your own disorganization is another. Safe from heirs not knowing where it is another. A good strategy answers more than one question. For some people, that strategy will be simple. Stay under insured limits, keep records, avoid dormant accounts, and maintain good documentation for others. It will include multiple banks, multiple currencies, brokerage sweep discipline, professional tax advice, estate planning, and legally reported foreign accounts. For a smaller group, it may include relationships with banks in traditional wealth jurisdictions, not because those jurisdictions are magical, but because they may have stronger asset ownership cultures, longer dormancy periods, more experience with large transfers, and legal processes that require more steps before outside claims are enforced. But every person must start with the same principle. Do not wait until you need access to money to discover the rules that govern access to that money. That is the mistake. People prepare for investment volatility. They prepare for market drawdowns. They prepare for recessions. But many never prepare for banking friction. Then one day a wire is delayed, a withdrawal is questioned, an account is closed, a transfer is blocked. A compliance department asks for documents, a dormant account is transferred, or a crisis creates controls. At that point, the problem is no longer theoretical, it is personal. So let me close with the principle that matters most. Control is not the same as ownership. You can own an asset and still lose practical control over it for a period of time. You can have a bank balance and still face withdrawal limits. You can have legal money and still face compliance review. You can have foreign assets and still face reporting obligations. You can have cash and still face payment restrictions. You can have a safe investment and still lose purchasing power to inflation. That is why the goal is not merely to own. The goal is to maintain access, flexibility, legality, documentation, and real value through changing conditions. That is what financial resilience means. The banking system is not going away. Banks will remain essential. Digital money will remain useful. Regulation will remain part of modern finance. But the naive idea that money in a bank is always simple, always private, always accessible, always protected, and always under your exclusive control is fading. The people who understand that will not need to panic. They will make calm adjustments. They will spread risk. They will keep records. They will use the right institutions. They will stay compliant. They will think across jurisdictions. They will protect purchasing power. They will treat banking as part of their risk management system, not as an afterthought. And that is the point. The rules are changing. The system is becoming more monitored, more conditional, and more complex. You do not have to be afraid of that, but you do have to respect it. Because in money, as in life, the biggest mistakes usually come from assuming that tomorrow's system will behave exactly like yesterday's system. It rarely does. The people who do best are the ones who recognize the change early, understand the mechanics clearly, and act before they are forced to act. That is how you avoid being trapped. That is how you protect what you have built. And that is how you keep control of your money in a world where control is becoming the most important asset of all.